Good afternoon, everyone. Thanks very much for joining this episode of Wealth Talks. Today we're discussing the family office fraud. Now, I'm Zach Lucas, partner with Spencer West LLP, and I'm joined today by three panelists. First is Mithun Ghosh, Group Chief Risk Officer of Taurus Wealth. Taurus Wealth is a multi-family offices with offices in Europe, Middle East, as well as in Asia. They manage in the region of about 3 billion worth of assets under advisement. We're also happily joined by Stephen Branford, partner with KPMG in Singapore. Stephen heads up their private client, private wealth department there, as well as doing family office work. And then lastly, very, very happy to be joined by David Brownbill, King's Counsel of 24 Old Buildings based in London, to discuss some of the aspects on the fraud and the family offices that we'll discuss at the end. Now, today's agenda, we'll first start out by setting the scene of the industry as it stands at the moment. So we'll look at family offices and financial risk management. And here Mithun will help to guide us through where we are in terms of the industry and in terms of the family office growth and what this is leading to in terms of their investment proclivity for private equity deals. We'll also then look more carefully at their private equity investment, the financial due diligence that can go into this if family offices opt to do this. And Stephen will help me to run through typically what would happen on a mandate to look into the offering of either a fund, an indirect investment, or a direct investment into a operating business. And finally, David and I will discuss the financial fraud legal consequences. And here we're really looking at the fallout that can occur once you unfortunately have invested into maybe a Ponzi scheme or something that was maybe not what it seemed when you first invested. And we'll talk about some of the remedies and the differences between parties that are either net winners, so they've actually been able to extract value before the fraud was discovered, or alternatively and more reasonably the ones that are actually net losers, where they're actually going to lose out on the investment. Now, before I get started on the main discussion points, as always with these wealth talks, this is an honest discussion between practitioners about the industry and about what's going on, and shouldn't be taken as constituting any way legal advice and shouldn't be relied upon as constituting legal advice. So it's just it's freely expressed views about what's going on in the industry and should be relied on in that way. Okay, so looking at the financial risk management, I think the first thing, Mithun, I would invite us to talk about is the emergence of single family offices. You're lucky because you sit in Dubai, but also you have coverage into Southeast Asia and Singapore. So you're getting to see both of the limbs that occur. And just looking at what's trending, because I think this will set the scene for everything that follows in the single family office space and the typologies. And here, what I mean by this is the difference between the families that come in as an investment office, particularly, and sometimes in Singapore, we see a migration aspect. So it could be a migration office to that extent. And then the large families, the actual multi-generation, multi-branch families that come in. I wonder if you can just give us and share your thoughts on the type of family offices that are trending and are actually occurring in both the regions that you cover.
Thanks, Zach. So I think you touched on a very crucial aspect there. It's important not to make generalizations given the sort of variety we have in the space. So they come in different shapes and sizes. At one end of the spectrum, when it comes to single family offices, you have extremely sophisticated setups, very professional individuals manning different desks or focusing on different asset classes or investment opportunities with sufficient analyst backup, systems at their disposal, including legal and compliance search engines for background verification, what have you. I mean, the kind of setup that could put mid-sized institutions to shame. Whereas at the other end of the spectrum, you could have very rudimentary setups, 2 or 3 trusted persons of the principal, essentially running essentially focusing on coordination by cultivating a network of network on the sell side. And then representing the buy side interests of their principal, right? So, and then you have everything in between. Now, when it comes to private markets in specific, I probably just stating the obvious here, but the risk sets are extremely unique compared to the public markets. You have your performance risk, which is not just based on, you don't have the benefit of extrapolating off a lot of history of performance or fundamentals that are more obvious through audited reportings and what have you. But you could have a lot of opportunities that you're looking at that are disruptive in nature or very tech-oriented propositions, which require deeper sort of domain knowledge as to the value proposition that they're addressing, etc. And you're essentially assessing future potential and not reading off any history necessarily. So that requires a different approach vis-a-vis public markets. There's liquidity risks, there's regulatory risks. I think settlement risks are a very key part, given that oftentimes for the smaller or modestly sized family offices, you're not necessarily getting directly to the company, but you're accessing these through various channel structures, etc. Right?
Yes,
and the due diligence.
Yeah, we'll get to that, Mithun. I was just thinking in terms of the family office spread,
right?
Where do we actually see the growth? Is it going to be within clients that have over 30 million, but below 150 million? Or where is the actual growth coming from in the single family office market from your perspective? Because I think that then leads into the resourcing and the environment that they have to manage risk. But what do you actually see?
In terms of investment focus, you mean, Zach?
No, I mean just in terms of the size of the family offices that are able to be established. Are they over 500 million, or where is it in terms of?
Zach, our experience is it's a mixed bag, right? So the larger ones are sort of, we do see a fair bit of geographical expansion on their part for the larger ones. So we do see Singapore set up offices, also trying to gain a presence in the Middle East and vice versa, or be it up in Europe. And we do see sufficient proliferation across both markets of the smaller, more modestly sized family offices coming into being. It's a constant discussion for us because we always get into where they're sort of undecided and they come to us more by way of helping them incubate their models, etc. It always becomes a discussion about the benefits of a multi-family office versus a single family office at that level of the scale. And we do help a lot of these single family offices that are starting off, help them incubate, basically leverage our skill sets while they're learning the ropes, so to say.
Right. And in terms of the direct investment trends that you're seeing, you mentioned earlier around public equity versus private equity.
Right.
There's been a number of surveys that have been released recently by prominent private banks. It kind of gives the image that there is a continued commitment to private equity investing by single family offices. Is that something that you're seeing as a trend?
Absolutely. However, there are some mixed noises around that. And again, it goes back to the size and scale of the family office platform, right? Essentially, some of these studies that you're alluding to, if you drill in a bit deeper into what kind of sample set they've used, for those that have used larger family offices, typically 2 billion upwards of average AUM under management, etc., it seems to be a very distinct trend that private markets continue to be an area of focus. Right. One such study which dealt with the larger family offices put current allocations at about 25% and growing.
Yeah.
Whereas if you look at other studies which have a more representative mix of family offices that are probably managing downwards of 500 million, you see the corresponding allocation go down to 15% and probably a little more muted in terms of their optimism in allocating more aggressively to the space, to the private space, right? So it tends to be a mixed bag. I think a lot of it also for some of the more modestly sized family offices depends on their going in positions into 2022, their investment mandates, so to say. Yeah. So for those who have sort of bore the brunt of the corrections in the public markets and are feeling it, a little more defensive. When it comes to public markets, they're not too certain that Again, price discovery is a different animal in the private space versus the public space. So they're not too sure that discount factors have caught up in terms of the degree of correction witnessed in the public markets in the private space. Again, it's very discreet, private price discovery in the private market space. And again, sort of given the corrections that we have seen on certain counters in public markets, they're not too sure that for a reasonable investment horizon, a midterm horizon, where the public market opportunities don't sort of throw up the same risk reward. So
right.
Again, depending on the size, the investment mandate, the existing allocations and performance that they're sitting on, the discussion could be a bit more varied than that.
Right, right. And in terms of the average sort of single family office, what do we tend to see? I know that there's a range, right? But in terms of the growth area, surveys will show that, we've got this little bulge going on with family offices that have below 500 million in investments. And the question that comes up is how many of them can actually afford in-house professionals as against effectively outsourcing or relying on their network to provide a CIO, CRO function. Are you seeing the same thing, that the bulge in the family office market, the mid-sized ones, cannot afford to have on staff frontline professionals and tend to rely on their networks in terms of managing risk and assessing opportunities? Is that a correct description?
I would subscribe to that view.
Right.
So for the smaller sized family offices, there's definitely, it all boils down to cost benefit, right? The selection process also tends to be, I dare say, there's definitely the personality of the principals that comes through in terms of the resourcing. Oftentimes, when you're setting out from a small scale, the decision is between a trusted resource versus a specialist, and the two need not meet up in the same person. So, you're essentially relying on limited resources to cultivate the necessary networks. And that's where the focus should be shifting when it comes to risk management off the back of that sort of minimal resourcing. It really boils down to which partners you're engaging, whether you have access to specialist due diligence skill sets, where it is warranted, where you're looking to take a reasonable sort of access. Are you leveraging platforms that afford aggregation and therefore allow you to diversify sufficiently when it comes to your exposure to direct investments? All of that comes into play. So it's all about cultivating the right partners around you, and not necessarily, relationships at the end of the day form a very critical part of it, but to have some filtration mechanism to review the deal flow that you're seeing from your close.
So what would be the average AUM under management, or the size of the family office where you can actually afford to have a chief risk officer involved and frontline CIOs? And what would it tend to be? Are you looking at over 500 million, a billion? Where does it end up in terms of being able to actually afford professionals to come in?
I think some segregation of roles and responsibilities you start seeing above the $500 million mark. Below that, you typically see resources or individuals wearing multiple hats and leveraging off partner networks or specialist service providers more actively than otherwise, right? So actual experience could vary, but 500 million would be sort of a representative figure from our experience.
Just going through from a risk management strategy that you see SFOs adopting generally, and then comparing that with an MFO approach to risk management, and then the industry generally. So looking at the private banks and maybe some EAMs, etc. What do we see in terms of the single family office as distinct? Because we've talked about the fact that there are a lot of single family offices. They're probably not at the 500 million mark, so they're having to rely on their networks. But do they actually have a risk management strategy in place, or is it just basically relying on the confidence of the people that they're involved with through their sort of value network? Or how does it actually end up? And you obviously are a prominent MFO. How do you manage the opportunities that come along for your own? Because they will obviously be passed on to your own client base.
It's a great question, Zach. Now, to me, I think a good starting point is to be absolutely honest about what your capabilities are versus your own limitations. So say, and I can speak for Taurus with more confidence than when alluding to others, but in our instance, whilst we know we have deep expertise in global market asset classes and various paths to markets when it comes to public markets, we know we don't necessarily have the wherewithal to do a diligent top-down study on an ongoing basis, identifying opportunities that are of value to clients and bringing them to market, right? We're not a private equity house, typically requires a different set of skills and specialization when it comes to that. Now, shown a deal, do we have the wherewithal to review it, due diligence, etc.? Yes, but the whole point is in terms of sourcing the right sort of long listing it correctly, right? And that's where we spend a lot of our due diligence efforts on cultivating a network of trusted partners, right? People who understand the generic risk appetite when it comes to our client base in this space, etc. Right? So one is due diligencing at the level of the partners itself, what kind of access they have, various criteria comes into play there. Track record, cap table status, co-investment partners, and all of that, right?
And is it probably the case that you have to adopt that approach because the cost of actually doing personalized individual due diligence would be just disproportionate, and that seems to be the problem? Is
again it's very context specific. Typically in the context of a multifamily office, given that primarily we're about asset allocation on a managed or advised basis for our clients, right? At the end of the day, private equity forms a allocation within the portfolios, and that also on a suitable and appropriate basis. Where risk appetite doesn't warrant, there'll literally be zero allocation to private markets in a particular client portfolio, right? So it's part of our activity set, which requires a deeper set of skills. And so if the business happens to be a private equity specialist oriented or focused business, and their reason to be is entirely to do with private markets, that sort of from a cost benefit perspective would justify maintaining resources entirely along those lines.
Right.
The skill sets, right?
In terms of the general market at large, so the sort of financial services sector generally, have you seen anything where there is a heightened level of due diligence on the risks of fraud, the risk of a Ponzi scheme, the risk of actually the books not actually working out when it comes to private equity? Have you seen any of the operators in the market space that systematically go through this in a way which is not networked, but actually they go at the due diligence in a personal way? Have you seen any of that?
So, Zach, I mean, I touched on the first layer of due diligence would essentially be about cultivating the right partners. A critical, very second part of due diligence on our part as a fiduciary responsibility to the clients to whom we're bringing these opportunities is around due diligencing the access structures. Are there sufficient independent checks and controls, background checks of all the controlling persons? Are there administrators? Are there auditors? What is the valuation policy? Is there any leeway around that? Again, all the risks in this space are essentially exacerbated by the information asymmetry, right, versus public markets. And there, a critical part of our partnerships or reliance is around the quality of information that they typically have access to.
Exactly.
Your diligence can only be as good as the information you have access to. And we often walk away from opportunities that seem great on the face of it, purely because we don't have a sense of comfort having come by too limited information, right? And we're happy to let that go rather than bring it to our clients and classify or qualify the risk inordinately, right? So that's the second part. And the third part really is, it goes back to Finance 101, where, and I'm not talking necessarily about the large offices which can afford sizable tickets and allocations where they're confident about the opportunity on the back of their own due diligence. But for the smaller offices or even our high net worth clients who utilize us as a multifamily office directly, a lot of the effort we expend is on affording structures that allow for sufficient diversification.
Yeah.
So you don't, if you've got a $20 million exposure to private markets, you don't necessarily want to put $1 million ticket into one single name.
Yeah.
As good as that opportunity might look to you.
Yeah.
So a lot of our advice is around limiting that and allowing for our clients to participate in good opportunities for as little as 100,000 a pop.
Right. I think just to wrap up on this, if we were just, there will be professionals that are watching, have tuned in, that are involved in the SFO market. Risk management may be something that they are not thinking about. It's a bit like cybersecurity. It's another thing that perhaps is not elevated to a level yet until it happens, right? And then it's the number one thing.
Absolutely.
But if we were looking at it from the risk management evaluation side, key pitfalls and best practices, just generally, if we were trying to give some good advice to any of these professionals that are looking at this and thinking that actually we have nothing in place to manage risk, what would you say are the key pitfalls that are currently being observed on single family offices that we would try and correct, or at least try and ameliorate?
So I think we've really touched on them, Zach, right? Again, for the more modestly sized offices that don't necessarily have the necessary wherewithal under their roofs to do a deep dive due diligence, be it from a financial, legal, or settlement perspective. For them to partner or to source transactions or to long list or to get advice from a set of professionals that are probably better equipped at doing it. And these things take time, right? It's not overnight. You come across a partner, you gain experience over time.
Yeah.
Them understanding your investment mandate, your risk return objectives. It goes back to financial management 101 again, right? So and going beyond just the comfort of ABC is a trusted name. I've known him for 20 years. If he's bought a deal, it merits participation, right? You have to avoid the temptation of just leveraging relationships and on personal trust taking the dive.
Yeah, well, that's the whole basis of a Ponzi, is that's the whole point, is to make that sort of network come alive so that people are disarmed in terms of their suspicions, etc. Okay, all right, we'll leave it there, and I'll move on to taking more of a deep dive, discussing with Stephen. So Stephen, thanks very much for joining us. From the financial due diligence perspective, this is really looking at what we're seeing in the marketplace, so the current financial due diligence trends and demands, as well as particularly looking at the Singapore single family office demand. And here we're really looking at do we have a throughput of clients? Do we see in the market space generally single family offices trying to take advantage of some of the sort of due diligence processes that you at KPMG and your outfit can bring to bear, and just giving an idea of how the market is shaping in this space?
Yeah, thanks, Zach. That's a very good question. I think the way I look at it is comparing family offices to institutional LPs and their approach. As part of my practice, I advise funds that take in institutional capital, and it's not uncommon to see quite extensive due diligence questionnaires and due diligence processes being instigated by counsel acting for those LPs. I'm only brought in on the tax side, but usually we work with fund formation counsel to respond to those questions. I have only rarely seen it done on the single family office side. And it has been fairly rudimentary in terms of the requests that we see.
Yeah, I suspect that that's probably the case industry-wide. What you're seeing is probably repeated everywhere else, that for the single family office at the non sort of sub 500 million level, which is the majority, they're not relying on direct due diligence. They're working the sort of network that they're connected to. When I look at the difference in terms of the private equity growth or the demand for this, do you see a difference in the risk evaluation of a direct equity investment in, let's say, a trading entity as against an indirect fund investment, maybe a feeder fund or otherwise? Do you see that there is different levels of risk when you're trying to evaluate each opportunity?
Absolutely. So with a fund opportunity, you're more than likely going to be investing into a regulated structure and a structure that has third parties involved in its setup and administration. And Mithun referred to some of the key players: fund administrators, custodians, lawyers, auditors. So if you can establish the appointment and ongoing participation of those third parties, that takes you a long way, in addition to establishing that the fund vehicle is appropriately regulated and remains compliant. An investment into a direct PE opportunity, into a trading business, is a completely different proposition. In addition to the risk of outright fraud, you have the risk of wastage. So you may have a founder who decides to pay themselves more than they said they would in the business plan. Is that fraud? Probably not, but it's certainly going to bite into your returns. And so our due diligence process is essentially the same.
Right. But if we're looking at it from the, single family office that's being offered a unique opportunity in a trading entity, are we saying this, that should be a little bit more heightened? There should be pause for thought on that type of investment as against, let's say, a Cayman fund, where you've got all the array of the usual sort of suspects and custodian, etc., being put in place. Is that what we're saying, that they should be cognizant of the different risk levels that are being presented?
Oh, absolutely, absolutely. I mean, you can reduce some of that risk going into a direct opportunity, and it's not uncommon for a portfolio company, investee company, to be required to provide audited financial statements. But audit is always ex post, right? You're not going to catch things in real time. Information rights are very common, as you would know, given to investors. But how often do we see clients exercising those information rights, going in and kicking the tires of one of these portfolio companies? Seldom.
I suppose the level of equity acquisition is going to make a difference. If it's a small stake,
of course,
probably there's no point. They're probably having a punt at that point. But if it's a takeover, then that's quite a different proposition.
Absolutely, absolutely. And I guess there is some opportunity from time to time for family offices to club together and socialize those costs amongst the cohort of investors that go directly. Family offices, depending on their relationship, may also be able to gain some insight or some comfort from the due diligence and monitoring undertaken by a large VC. But there is always a danger in this process of relying upon the work of others unless you've actually verified how extensive that work is.
So the last thing on the fund side, should we be particularly concerned of feeder funds as against having just a singular fund? Is that in any way seen as a more challenging proposition in terms of due diligence?
Yeah, so potentially. And I would say in addition to feeder funds, you've also got what I call club deals. So you may have a Singapore company, Cayman company, where 5 or 6 single family offices pile in. That's not a fund because it's not an externally managed structure, but it more or less is set up to facilitate that single investment. Unlikely to be regulated, unlikely to be audited, and you're one additional degree of separation from the actual deployment of your capital. So that creates additional risk. Feeder funds, like the ones that were used in Madoff, the third-party managed structures, add a layer of abstraction. You're even further removed from where your capital is deployed. But also there's a additional layer of credibility that's being applied to the structure, which as an investor you should feel entitled to stress test.
But I think looking at the due diligence process itself, just going a little bit more deeper into this, there are going to be sort of red flags that come up. And I'm going to list a number of red flags that typically come up, and we can walk through some of them. The straight line income capital growth, so too good to be true. That tends to be a recurring theme all the time and it's probably forever after, right? And that's part of the attraction. No regulatory oversight, which you mentioned. Accounting irregularities if we're doing it on a desktop basis. Poor financial governance, so CFO turnover, external audit changes. Poor administrative governance, no functioning board of directors, everything's run out of the CEO's office, no effective oversight. Adverse background checks, and then any others. Now, the reason why I list these red flags is just for us to kind of pick out which ones would be captured in a standardized due diligence process, and which would be more colorful and would require us to get a bit more professionals involved. So just to give an idea of what can be expected on a normal due diligence process when we're looking at some of these private equity deals.
Yeah, again, it depends if you're going into a regulated structure or if you're not. So if you're going into a regulated structure with those third parties that I mentioned, it's not difficult to verify A, their appointment, and B, the regulatory status of the entity or the manager. You can get a certificate of good standing for a Cayman entity. Obviously, you can get one in Singapore, and you can pull out a BIS file and see if a Singapore company has an auditor appointed. So that's very basic, simple desktop investor-led due diligence that frankly doesn't require a whole bunch of expensive experts. But more than that, the whole posture of embarking on a due diligence process, I think, will help to provide some verification that you're not investing into something that's an outright fraud. Because as soon as you adopt that posture, then the promoter of something that's an outright scheme is going to be telling you the opportunities passed you by, would be my guess. Yeah.
In terms of the accounting irregularities, what are we looking for here? I mean, what's the telltales that, typically what would we find that say, these guys are booking sort of revenue before it's actually been received, as it were, or they're booking expenses into other accounting periods. What are we looking for on irregularities? Because people will be interested listening to this as to what is an obvious red flag. I know that straight line, exponential sort of returns is definitely a red flag. But when we're looking at it more granularly at the accounts level, what do we tend to find that says this is something we need to look at more closely?
Yeah, so fundamentally, the audit process is about verification of existence and valuation. And that's in terms of revenue and expense items and assets and liabilities. So assets that are carried at a high value, that are illiquid, that are being constantly revalued, that would be something you would want to understand the audit methodology. And I checked with some of the partners in our firm, and they do get questions from LPs and funds about the audit methodology. And they have even been asked to prove that they are, or verify rather, that they've been validly appointed, continue to be appointed. And then it's other things around, revenue items as well. Overstatement, understatement of expenses and other costs items.
Right. Do we actually get involved in looking at the management team, particularly the CFOs, and looking at whether or not we've got a high turnover of CFOs on the particular opportunity? Is it something that's standard, and how the hell would we do that in practice? How do we find out that they've had problems with their internal controls?
Yeah, so that's not going to fall into the bucket of financial due diligence, but certainly that's a pertinent thing to watch out for. Particularly in those key functions where there is, if not strictly personal liability, there's certainly reputational damage for the individual who's been sitting on that seat if things aren't the way they should be. One thing I would add there, Zach, is that possibly a red flag, possibly not, but certainly a risk area is professionalism and diversity in terms of board composition. So if you have a vehicle that is only run by the one promoter, question that. Run by the one promoter and somebody with no professional experience or immediate family members, I'd be thinking twice about that. But as soon as you start seeing bona fide independent third parties, particularly third parties who are there because they have some other connection with the structure, such as they're a fund administrator, that you can usually take a bit of comfort from that, because those guys are going to be ringing alarms if something's awry.
I suppose the other bit is, if we see the auditor changing all the time, would that be a red flag? So if you've got a bunch of accounts going back a number of years and you're looking through that, if you see the auditor changing quite often, would that be a red flag?
Yes and no. I would probably say the red flag there would be a long delay in the delivery of audited financial statements. Typically, it would be if an auditor is retired because they're not comfortable, they're about to qualify the accounts. It's not typically a simple matter to go and find someone else who's happy to sign off on them.
See, right.
Unless they're not up to scratch.
Yeah. Well, what about the opposite? You've got the same auditor, which is potentially not at your scale, but maybe over a corner shop, and they've been on it forever. Would that be a red flag? Because I think, wasn't that the case in Madoff? He had this same auditor the whole time, or maybe there's some of the other cases.
Yeah, I can't say that's a red flag. But I know actually that is one thing that, not just in this context, but broadly, is being looked at in terms of audit rotation and having fresh eyes.
Structures. Right. I think finally, on the adverse background checks, how much do we actually look into the previous history of the promoters or the sort of management team that's proffered as the professionals that are managing this? Do we actually look into their backgrounds, and how far do we go?
Yeah, I mean, I would say it's not something that we're asked to do much, if at all. But I think it's well worth the spend, even if it's an allocation of time from the investor side, to do a little bit of desktop due diligence, have someone run a basic KYC check. And if you want to dig a little bit deeper, there are providers, and not necessarily KPMG, but there's providers who will do reputational due diligence. And really, at the end of the day, it's about, as Mithun said, in terms of the financial investing, this stuff is not rocket science. It's basic. It's weighted by reference to how much capital you're deploying. You take a pragmatic approach. Diligence is not always a six-figure proposition. Sometimes it can be done much more efficiently, but flush out those main red flags that you've identified there.
Yeah, I mean, what I was thinking about in this context is a bit like what the revenue do in investigations. They'll look at unexplained wealth. So we have a relatively young guy who doesn't have much of a track record because he hasn't been on the planet very long, but yet he has, flashy cars and has an Instagram account with flashy watches and living the life, but it doesn't actually stack up as to how on earth did you get all of this wealth. I think some of that, in retrospect, when you look back at some of these obvious Ponzi schemes, the typology is always the same. They're going to take it in, start buying houses, start, lavishly living and all the rest. It's all obvious and it's all public in many cases. But I don't, some of those checks, what you're saying is not something that's typically done. So we're not looking at the obvious in many respects.
Yeah, and I'd add to that, Zach, some asset classes are more susceptible to abuse in this manner than others. I mean, I think I'm not going to pick on crypto, but crypto is classically something that not many people really understand very well. There's not many clients I have who can pull out the code on GitHub and explain or verify that something is actually a real project. And so, there's that level of disconnect between what actually makes sense, what can be understood and digested by an investor. That's where you may need a little bit of more technical assistance in terms of the proposed.
Okay. All right, I think we'll leave it there, and then we'll transition, discuss if we've got ourselves into a position where we've actually got a financial fraud that has occurred. We are a single family office, and looking at the legal consequences of that. And for this, I invite David to help me to run through some of these consequences. Before we do that, though, I just want to explain the concept of a net winner and a net loser, because it occurs quite a lot in the cases that deal with some of these sort of Ponzi schemes and financial frauds. And really what they're getting at here is this, and this is a bog standard diagram of a typical family office where it's held in a trust. So you have your trustee beneficiaries and you have your various power holders, potentially settlor and protectors. Then we've got the underlying company through which the investments are made and the directors of that. And then the underlying PE fund. Now, what they mean by a net winner is that, in effect, payments were received during the currency of the fraud. And actually, you could have a good return on your investment. And so you're a net winner. And when it's later discovered, the worry there is, well, if I'm a net winner, are we going to have to effectively divest some of this net winnings from what was otherwise a simple fraud? So there was no actual business underlying any of this. And then the reverse is a net loser. And so here the trust sat on top of a company, and we've not had any return. And that tends to be the situation of most of these schemes, is that we have net losers where they've invested and they're unlikely to recover much in the insolvency proceeding. And so there are different angles to why this is important from the analytical context, when I'm looking at the legal consequences. But that's what we mean by a net winner. I've been able to get my funds, and it was a great return as long as it lasted, and then it went bust. And then the others where I've invested in and I've not had any return on the investment, and so I am a net loser. Now, looking at the net winners, there is a range of remedies and rights under the insolvency proceedings to try to claw back some of these net winnings, right? And this is always the worry for any of the investors. And it would be for a single family office that actually gets embroiled in any of this. One of the principal worries would be, well, are we going to have to divest any of this money back into the insolvency? And so I'll run, we don't have time for all of these, but I'll run through all the principal remedies. It's not exhaustive of what could be met. So we'd have voidable preferences, undervalued disposal, fraudulent trading, knowing receipt, unjust enrichment, conspiracy, and then constructive trusts. Now, I list all of this because I wanted to chat through with you, David, in terms of the overview of all of these remedies seems to be a concentration of time on the period immediately running up to the insolvency. And so some of these statutory remedies of voidable preference and undervalued disposals, and then the more sort of prosaic remedies that are at law rather than statutory driven, which look at the involvement of the investor in the scheme that's gone bust. And I just want to invite you to comment on any of these remedies where we actually find that the investor can get into difficulties on a clawback because of the amount of, let's say, knowledge that they have, or the way in which they've interfaced it with the investment, and what we see typically in this sort of scenario.
Yes, indeed. The primary aim in all of this is, of course, the desire to have an insolvency which distributes the net assets of the company on a pari passu basis. That's the goal in almost all insolvency proceedings. And that pari passu basis does require the recovery of some of those prior payments that you just mentioned. And you've got this list that you just got mentioned just now. You've got a series of payments which will be recoverable in certain periods before the insolvency has taken effect. Somebody's got to prove that the company went insolvent on a particular date.
Yeah,
and that itself can be an issue. Yeah. And there are different requirements in different places. Who's got the burden of proving that? Sometimes it's the recipient, sometimes it's the liquidator if it's a company. And of course, do remember, probably not too important in this environment, is that the rules are different for a personal bankruptcy to a corporate insolvency. I mean, that could arise in some of these circumstances. Most of the time, you're talking a corporate situation, and there are differences as well. I mean, some systems for very early periods before the insolvency, it doesn't have to be a connected transaction. A longer period is allowed for connected transactions. And who is a connected person with the company? Will it be all of the obvious suspects? And most usually it will be one of the investors will be connected, and therefore you've got a slightly longer period. So those recovery items, which would be, as you've indicated, the avoidable preference, undervalue transactions, they tend to lead to a series of other opportunities. Because once you can say that there is a right of recovery, you could then be into other remedies, at which you've indicated that knowing receipt, unjust enrichment, constructive trust, to try to recover the net is, as always, it's one thing to have a right of recovery, it's another thing to actually recover.
Yeah, I mean, the funny thing is that as you go down the list, it gets more serious. The case law tends to adjust and say, well, how much of your involvement in the scheme will give an idea for your exposure to some of these remedies on the clawback. And so it gets to the point where you look at the whole thrust of us undertaking due diligence to warn against investing into a financial fraud. The more we know, the worse it gets in terms of if it goes wrong, potentially in a round way. So that if you have an inkling, or if the documents are revealing that there is something that's amiss, then you're more on notice than someone who just was taking a recommendation by a professional advisor and just getting on with it. Because that's when you should be more concerned that actually you're going to potentially be looked at by the insolvency practitioners after the event, because clearly something was amiss.
Yes, but I think we have to, first of all, distinguish between the due diligence before you go into the investment and information you may glean in the course of receiving benefits from it. I'm trying to speak as broadly as I can there. They are far better not to go into something that's going to fail.
Yes, yeah.
There's no possible advantage in holding off your initial due diligence.
Yeah.
It would be unusual, I would say, that once these funds start operating, that the average investor would be alerted.
Yeah.
Something very specific that's wrong, because by far and away, and our other colleagues on the panel will know better than I do, by far and away, the biggest problem will be no information. Coming.
Yeah, exactly. Yeah.
A lack of reports and such, which of course alert you not so much that something that you might receive has got a problem with it. It is just that you're not going to receive anything. Yeah.
And I think that's interesting, because some of the recent cases on unjust enrichment, the courts take the view that there is a legitimate expectation that you'll get a return on the contract, on what you agreed, or the investment that you made, and that they will protect that. They won't easily unravel that because the underlying edifice of all of this was a fraud.
Yeah, well, for unjust enrichment, somebody's got to prove it's unjust.
Right.
And that's so much is written about this topic, and it becomes almost mind-bending because it's so confusing. But it's actually quite a simple set of concepts, and the unjust element is often not there simply because you do have a contract which gives you an entitlement, and that entitlement has been triggered. Yeah.
I think that's certainly the sort of Caribbean Cayman approach, BVI approach, when these have come out. And a lot of the case law in this area is it has given rise because of things like Madoff and latterly Stanford. So we've got a lot of case law at Privy Council level dealing with this, and they tend to respect the fact that you are a sort of bona fide investor and you didn't have a clue what was going on. And so they don't easily try and unravel that, because underlying it all was a fraud. I think it's different approaches maybe in the US to this, because I think they take presumptions, and I think there's some developments in Canadian law where if it's too good to be true, then that should alert you. But certainly that's not been the position in the Caribbean courts and the Privy Council's decisions dealing with this. They have tended to protect and respect the fact that you are contractually entitled to the distributions that you've received.
Yeah, I think the too good to be true is much easier said than actually dealt with. What is too good to be true in this environment? I think Stephen quite rightly mentioned earlier about the investments in crypto related funds, and quite rightly indicated that most of the people sort of going into these things don't really understand what on earth it's all about.
Yeah.
But equally, there was a recent failure, wasn't there, of a fund. I think it was based in the States, in which it was taking in investments but lending cryptocurrencies.
Right.
And this fund was promoting itself with very high returns. It was saying that going to get you somewhere around 17, 18% on funds invested. Yeah. Well, two things come from that, don't they? First of all, however sophisticated and complicated crypto is, most of the money losing is same old, same old. Yeah. Because to get a return of that size at a time when average interest rates, they may have gone up a little bit in the past 6 months, but they were rock bottom. To get something like that in itself isn't a red flag of a fraud, but it's a red flag surely of high risk. Yeah, yeah. But we haven't. Yeah. I was going to say, how do you link that? How do you go from there to too good to be true? So the biggest complaint, you can go through a whole series of these things. Yeah. Where there's been substantial promises made. I would say it's not so much a red flag of it's bound to be a fraud. Yeah. It's a red flag of something that's very, very high risk, and you've got a dreamer of an investment manager. Yeah. Yep. You just look at Barlow Clouds all those years ago. They were offering very high rates. Trust. So I think it's quite a difficult thing, the too good to be true. Yeah, and it doesn't figure very much in terms of the cases. I know I mentioned some of these the developing Canadian cases. There was one, I think it's the sort of Whitfield or Whitman case, where basically the judge is saying you conducted no due diligence, it was a high rate, so I'm assuming that you knew that there was something wrong here. But I don't know if we'll see that as a general approach going forward. Who knows? There's going to be more and more cases as we, that's just life. So people will take a pop at this, and we'll have to see how it develops. But certainly from a Canadian perspective, there is that movement towards, well, if too good to be true, then that should be tainting you as an investor into this, unless you can prove otherwise. And I'm not saying that that's the approach that will be adopted in the Caribbean, etc. But there are some of these cases circulating where there may be a counter to this, that you need to take a better care of, things that are ostensibly a high rate of return. Anyway, in terms of the net losers, now this is where the family office is invested in and it's lost, and it's part of the insolvency. We'll see how much we recover from that. Now, this will always give rise to a review of everybody's role in the run up to this and during the currency of the investment itself. And so I'll just invite us to run through, looking at it from the beneficiary's perspective or from the aggrieved party's perspective, the liability scope that could be engendered by the trustee, by investment power holders, by the underlying company directors, and I mean these individuals here. And then later on, we can discuss third-party investment advisors. But just running through, generally, if it goes wrong, what would it look like in terms of the unfolding review of everybody's role and how they will sit? Certainly. Yes, we just have to recognise that any of these parties got to recognise it. If there's been a significant loss, those that consider themselves to have lost will be looking for somebody to compensate them for that loss. Yeah. So each and every one of these will be one way or the other in the firing line. But by the same token, they can protect themselves to quite a large degree, most effectively by just doing their job properly. Yes. Yeah. If you go from the bottom upwards, third-party investment advisors as just about everybody knows, it's a pretty barren place to be to try to sue an investment advisor for poor performance. I think there've been tiniest handful of cases, and again, I speak outside of America, but in the rest of our sort of common law, Commonwealth connected world, it's been jolly difficult to bring claims for effectively for negligence against an investment advisor. Given the range of opportunities open to them, the range of possible factors which are brought into account, and of course defining the obligation that they owe. What did they promise? You may have mechanical areas that you can complain about where they have gone outside of the investment criteria, and it's a question of whether the arrangements with them did in fact prohibit them from going outside. If you then move up the list, because I've deliberately done this upside down, Zach,
Yes.
You move up the list because of what I just said then, perhaps then there's an obligation on those that enter into these arrangements
Yes.
to make sure that they are sufficiently clear and protective of the investor. So, and that's going to be quite difficult because most of this is standard form documentation.
Yeah.
Most of it is extraordinarily opaque and long-winded. And you're back to the stuff that everybody's dealt with at university about that kind of documentation. There's protection for the man in the street usually, but there's very little protection for the so-called sophisticated investor. In this environment, if you sign up, you've committed, no matter how much of the 200 pages you didn't read. But if you haven't read it, then that's going to become a big issue.
Yeah, and certainly from the underlying company, if you've got director service agreements with the usual indemnity provisions, or at least the exoneration provisions, anything up to fraud, I suspect, will be covered. Yeah,
sometimes difficult in most places to actually formally exonerate. It's done indirectly through an indemnity provision, which is somewhat tighter than what you can do at the trustee level. There are limits because statutory obligations to provide a certain level of service provision. You can't get out of that. That's usually a non-negotiable. But it's there, and bringing claims against those directors that be brought by the company against the directors. What those that have lost will be looking for is somebody to pay them back. And inevitably they're looking for a deep pocket. And when it comes to professionals, they're either looking for an institution or they're looking for an insured professional.
And I think this brings up an issue that we've been sort of tackling recently, which is around some of these directors may well be connected to the sort of licensed trust company. And so the issue is, notwithstanding the trust may contain the standardized Bartlett provision to help the trustee to avoid some of this risk, does that actually fail because there is this connection between the two? The trustee and the directors are effectively the one person.
Doesn't that go back to the service obligation that was assumed when the fiduciary company, when the trust company set the arrangement up? And this is a developing area. It's something I have spoken about over the years. But these relationships are much more complex than sometimes understood to be. Yes, you haven't yet talked about the trustee, but the trustee can protect itself at a certain level. But that, not so much the trustee, but the trust company may well be providing other services. It's presumably providing them not so much to beneficiaries, but to the underlying companies.
Exactly.
So is there a what is the relationship between the trust company in its big umbrella, which is providing directors at the corporate level? What is the obligation to the company? Is there some obligation to provide suitable directors Is there an obligation to oversee those directors? Are you assuring by implication that those directors will be doing a proper job?
Yeah, yeah. I mean, in many cases, the trustee may be doing it for AML purposes, that they want to have coverage of what's going on at the company level in order to stay compliant.
Well, that is exactly the problem. I wrote an article about 20 odd years ago called sort of directed trusts and the problem of knowledge.
Yeah, yeah.
It's really difficult for the trustee to avoid lots of liability if it knows things are going horribly wrong.
I think finally on this, in terms of the power holders, obviously some of them, depending on the terms of the trust, some of the power holders will obviously may have power to appoint and remove the directors of the underlying company. The question is whether or not, and as a matter of construction, that then brings them into having to have some obligation to appoint and remove directors that are competent, and the terms on which they are appointed and removed. I know it's not an area that's necessarily been looked at particularly, but it could be something that comes up in the future more often, where we have power holders that do have direct rights to effectively nominate the executive team on these family offices.
Yes, your average Bartlett or anti-Bartlett clause says that the trustee can leave the management of the company to the board and not to interfere. Does that necessarily absolve the trustee from having to worry about who's actually on that board? I'm not entirely sure that the average clause does that.
Well, it doesn't cover a power holder because it's addressing the trustee.
Yes, but it's a slightly different question, isn't it? It's your question, and I think it's, if I may say, it's a very good one, because everybody's looking for gaps in this modern day shield after the Hong Kong decision. But does the average anti-Bartlett clause say to the trustee, you don't have to worry about who is on the board? Is it giving you the saying, do you just take the board as is and that's the end of it? I'm not entirely sure that it does. I mean, it's not the same as Vista in the BVI. It prevents the trustee from using its power to interfere with who is on
well, there's developing case law in Singapore, I think, on these points. So we'll have to see how that all pans out. But it's the whole array. I think the point for everyone viewing this is this: if it goes wrong, there's going to be a review of everybody's position on this, and everyone's going to be looking very carefully at where are the deep pockets, where are the good covenants when it comes to recovering some of this, particularly if we've got a complete bust Ponzi scheme underneath and we're not going to recover anything. So everyone's role will be looked at individually, and the trustee will be looked at if it's a licensed trust company, because they are insured, and that's going to be a source that people will be looking at to try and make recovery. Okay, so I think that's a bad situation to end up in. I think the better way of looking at this is what are the takeaway points in terms of best practice to try and avoid getting in there in the first place going forward. And I've listed a few best practices here. So the single family office should at minimum have an effective governance and control framework. That means that they've actually looking at this as a potential area of loss to the family office. And in that, they have a private equity due diligence protocols, so things that they should look at to try and enforce directly and maybe not rely on their confidence network of providers. They should perhaps look at invoking the due diligence process, the direct due diligence process, and perhaps Stephen can mention some of the costs involved in this thing on a case-by-case basis. And then they should effectively monitor what they've invested in going forward to see whether or not all is in order. And then just any other thoughts. But I list these out, and I invite David, just from your perspective, the crux of it all comes down to the quality of the individuals involved in the single family office investment environment, and how effective the trust, if you have one above that, how effective that is being effectively enforced and adhered to going forward. Is that basically what we're what we're saying is that if you're trying to provide some level of protection for this, it all comes down to the quality of people involved and the framework, the control framework through which they operate.
Yes, I look at this from a slightly different position. That, you know, I'm not as involved directly in these arrangements such as Mithun and Stephen are. They're directly involved in all of these transactions. I come into it at a different place, but I always liken these investments to saying, well, what you're doing is you're buying a minority interest in a private company. You're not even getting control. You're buying a minority interest in a private company, and typically we do a fraction of the due diligence than we would if you were buying a piece of a company in an ordinary commercial situation. You know, if you look at in the books, you know, buying the shares of a private company, they're vast, and the checklists are vast, and the kind of things that you should do before you enter into these things. We don't, because of this, it's what I call the private client bias. If you do things wearing a commercial hat, and you go to your sort of commercial law firm, your chartered accountants, and you're saying, well, there's this local company around the corner, I'd like to take it over, or I want to make an offer. Everybody puts on a different hat. But when it comes to these investments, it's a very different state of affairs. And I know to do the due diligence that you would do in an ordinary commercial situation is probably just not feasible in these cases. It's just not going to be cost effective and so on. But you have to recognize there is a massive difference between the two processes for doing something which economically is not a lot different.
I mean, maybe Stephen, you could speak to the direct due diligence process. How long would that take, and you know, what's actually, you know, is it a high touch cost, or is it modest, or what's involved in all of this? Because if the SFOs are not even looking at it, probably they don't realize that these things are available.
Yeah, it very much depends, Zach, on the size of the business and also where it is in terms of its funding rounds. So if you're doing a DD on a mature business with a trading history, proper accounting records, it should be fairly straightforward. It should be a desktop mostly review. Whereas if you're doing a due diligence on a couple of founders who have an idea for a startup, then clearly most of your time and effort is going to be focused on the promoters themselves and validating the concept and idea they want to take to market. I think one point that I would like to make, though, is that it's best practice, good practice for not just the family office investors, but also the investee companies themselves to get an early taste of what real due diligence looks like. Because if you've got an early stage company that's start out's fairly scrappy, as most of them do, if they scale and become successful, there'll come a time where the bigger institutionals will pitch up, and they will have a whole long list of demands. And if the investee company hasn't had an inkling of what systems and processes they need to get in place from the outset, it's a bit difficult to put that back together.
Right. Okay, Mithun, from your perspective, do you? I think we discussed earlier that there doesn't seem to be much of a framework in place for the SFOs to adequately manage their risk when they're doing this. Would you endorse that they should actually have some protocols, or at least some approach on the books to manage the risk going forward, and that someone should take responsibility for this?
No, but of course, Zach, I think, you know, we deliberated a fair bit on whether for the SFOs as a whole, private markets continues to be an emerging area of relevance or not, so long as there's any allocation to the space. And do keep in mind that we're coming off a changing world order, right? Liquidity is going to tighten. It's not going to be as freely available as before. And a lot of buy-side behavior, as we traditionally know, is driven by what sales side focus you get, right? And I see capital seeking companies casting their nets wider in terms of diversifying their sources of funding. Intermediaries whose livelihood depends on getting capital from the sale side, from the buy side to the sale side. They're going to go down the sort of food chain, if I may, in terms of capital providers. So a lot of these SFOs, irrespective of their shape, size, prior sort of focus on the private space, are going to feel a lot more self-important with traditional sales chasing happening.
Right.
And so to my mind, irrespective of what gazing in the crystal ball on the back of some of these surveys might say, it is a pertinent area because they'll see more conversations and it may soon become a problem of plenty in terms of the pipelines that they start witnessing. So definitely going back to a very pertinent point David just made a while ago, a lot of it boils down to the commercials, right? Whether the cost benefit makes sense at the end of the day. So it's in the context of the stake that you're taking, the stage of the capital cycle that the company is in. If you're early stage and you happen to be co-investing, I mean, just the due diligence around the partner with whom you're co-investing and whether you can rely on their level of due diligence, etc., is one point. If it's a more significant stake and cost benefit justifies, by all means, look out for a specialist firm, and they're more than you can shake a stick at in terms of supporting you with a deeper sort of drill down basis the numbers that you have access to. If it's more advanced in the capital cycle, you're talking pre-IPO, late stage opportunities, you will rarely have access to management. You'll have to rely on information that your access partners sort of bringing your way. So definitely, if you don't have the wherewithal internally, an astute approach to selecting the partners you work with, that in itself is a critical due diligence.
Well, I mean, if we are going to be moving into recessionary times, then this tends to be Ponzi season. So it tends to surface a lot of Ponzi schemes. I think when we had the last in 2008, 4 of the major Ponzi schemes surfaced in the US in the space of 1 year, and that included Madoff. So this tends to be the point in time when you find out what's been going on for the past few years under the surface. So we will have to see. Okay, I think we'll leave it there today. We've got a couple of questions. One's usually what's the cost basis points you would see on AUM basis for SFO above 500 million? I think that's probably a question for you, Mithun, probably offline. Which of these in case Singapore that is related to anti-Bartlett clauses? Well, this is the current case that's been making its way through the courts involving Credit Suisse. Okay, those are the 2 questions. I think we can wrap it up happily today. Just leaves me to thank very much Mithun, Stephen, and of course David, for helping very much to contribute to this, and thank you for everyone that spent time viewing this, and obviously the recording as well as the slides will be made available in due course. So thanks very much, and hope you have a great day ahead. Thank you, guys.